Today, the stock market pulled back from critical resistance, and tomorrow we have FOMC. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. All right. Today we're going to do something a little different, and we're strictly just going to look at the price action with no indicators on the chart. So previously I had talked about the fact that all of the bears were going to be looking at this as the possibility of a giant head and shoulders pattern. And that is now looking a lot less likely because we did start breaking out a couple of days ago and we were making higher highs. This should be a reminder that you cannot jump the gun on any technical patterns. In order for this to be a head and shoulders, we would need to break the neckline before continuing lower, and then we would be able to say that it was a bearish pattern. Now, the other thing we have to look at is the possibility that this is a cup and handle pattern, which is a bullish pattern and could be a bullish breakout if we can break above this neckline, which is the highs above SPY 417. So looking at this candle today, we can see that we did start to get a rejection from critical resistance, and that is exactly what I just talked about last night, is that you should be very cautious at critical resistance, and you should not be expecting a breakout. You should make the price action prove it. So obviously, looking at today's price action, we did not get the breakout and we did get the rejection. But we also have this wick below the candle that tells us buyers were stepping in near support, which is going to be that level right around SPY 407. And we closed just below some critical support right around SPY 411. So going into FOMC tomorrow, as you can see, we have no clear direction on where the market is likely going because we just got rejected from critical resistance and we have not yet broken down to a lower low. So in order to get bearish on this market, we'll need to break this low down here, which is right around SPY 404, and that should be the start of what could be a downtrend. However, if we do not break that low, and let's just say we start to pivot immediately, this could be a next higher low before the next higher high, and we can start pushing higher towards SPY 420. That is obviously going to require the break of this high at 417, so you are going to see it in the price action. And if we break above 417, we're likely going all the way back to the August highs that could take us to SPY 430. So as far as I'm concerned, trading FOMC is going to be very simple because you just need to have patience, because we're either going to break the range below SPY 404 or above SPY 417, and that is going to set the next leg in this market. If we break out to the upside, you know to instantly get more bullish, and if we break out to the downside, you know to instantly get more bearish. And while we are stuck in this range, you need to be aware that it's going to be a very choppy market, and there's always the possibility we just chop around and continue to consolidate and build out some type of triangle before we get the breakout to the upside or the downside. So if you already have this bias that you know we're going higher or you know we're going lower, you are going to be very disappointed when the market humbles you and proves you incorrect. So do not buy all of that fear going around that the stock market is crashing, and do not buy any hype that the market is going to break out and start running. Simply let the price action do all the talking. You have a very clear range right here between 404 and 417, and your job as a trader is to manage your risk between this range and then wait for the confirmed breakout and trade the next direction. There's no reason for guessing. There is no reason to try to be a hero. And there is no reason to be expecting a crash just because everybody is scared. Keep in mind, when everybody gets bearish, they are typically wrong, and that would instantly lead to a very impulsive short squeeze if we had the breakout above resistance. Now, everybody being fearful and everybody being short the market is not a good enough reason to be bullish. So you just need to be very disciplined and follow price action and wait for that confirmation of the price action making this higher low into the next higher high. And then you can ride the wave and continue to stay on this bull trend. You can see this market since the October lows has been putting in higher lows, and we are continuing into this bull trend. And the only way we are going to get bearish is if we break that trend and continue into a downtrend. So very quickly, we'll jump over to the RSP, which is the equal weight ETF for the S&P 500. And you can see right here why a lot of people are bearish is because they don't like the fact that the equal weight S&P 500 is not keeping up with the bull trend. Now, in my opinion, this is a very difficult road to travel because only about 10 stocks move the market, and those 10 stocks moving the market is all you need to maintain the bull trend. If you're getting hung up on this idea that the breadth is not strong enough to continue a bull trend and you're seeing this head and shoulders on the RSP, you still need to wait for confirmation of the break below that neckline, because nothing matters until you get confirmation from price action. That means we would need to break below this neckline, and that would likely tell us we're going to continue lower. And a lot of this weakness is obviously coming from the financial sector and the small caps that are getting absolutely obliterated by the regional bank failures. Do not get sold on this idea because it is just an idea until price action confirms it. Now let's jump over to the NASDAQ 100 triple Qs, and we can see the triple Qs are getting this bull flag breakout, and as of today's price action, we simply came back down to the breakout of the bull flag and testing it as support. As I always tell you, never get bearish at support and never get bullish at resistance, and we are currently at support. So what that means is that if we did start to bounce from here, we could easily still hit this double bottom price target, which could take us up to the 327 to 330 range if we start to see price action bouncing off of this support. This should be completely expected and completely normal technical pattern price action if we started to bounce from here. Now, likewise, if we start to break down and we break down below this low and we continue lower, you instantly become more bearish and you manage your risk from that support, which is going to be right around triple Qs of 310. You can also manage your risk right here, right around the breakout, which is that bull flag breakout, which is exactly where we closed today. So closing right on top of support, we have no closure on whether or not we're going higher or lower, and a lot of that is going to depend on FOMC. Remember, we are dealing with a market that is battling inflation and battling fears of recession, and a lot of that uncertainty is going to be cleared up during FOMC, so it's definitely going to be significant to watch the price action tomorrow. Remember, the market's full of traps, so you need to understand your range on the triple Qs is between 310 and then 320. And the break of this range is likely going to tell us the next leg in the market. Next, let's jump over to the Dow Jones, which is also putting in higher lows since October. And we are currently trying to break out of this giant bull flag to the upside to see if the Dow Jones could get up there around 346 to 350. Now, keep in mind when you are following price action, you need to manage your risk at the previous bounce. And right now that's going to be in the low 330s, because if we break down below that, we are likely heading back down into a downtrend. So you need to understand that sometimes when you're following price action, it's better to just wait for confirmation. And right now we don't have a lot of clear confirmation in any of the indices because we are still stuck in a range. I just went over all of the three major indices and you can see they are all trapped in a range and we need confirmation of the breakout. If you want to guess that direction or you're so sold that we're going to crash and we're just going straight down, then best of luck to you, but I would suggest waiting for the price action to confirm it. And then quickly, let's jump over to the small caps, which you can see also have a very bearish pattern, just like the equal weight S&P 500, because a lot of this weakness is coming from the small caps and the financial sector. So as you can tell from this chart, we are at a very critical support at IWM levels of 170, because if we break below this, we could see a full-blown capitulation to the downside. Now, do not jump the gun. We need the confirmation of the price action breaking down below 170, and then we are very likely revisiting these October lows down here in the low 160s, and then we could even go lower than that. However, we need the price action to confirm it by breaking down below that critical support, because if we start to bounce from here and break out of the range to the upside, then that's obviously going to be a bear trap look from the head and shoulders pattern that had no confirmation. So the range on IWM is between 170 all the way up to about 180, and we need the confirmation of the break of this range before we get bullish or bearish. Next, let's take a look at the VIX, because a lot of this year we have spent a lot of time below 20, and that is just not what you're going to see in a bear market. You can see the VIX tried to break above 20 yet again, and every time it tries to break out, it gets crushed and the VIX closed down below 18. So going into FOMC tomorrow, we need to watch the VIX, because it's only if the VIX starts spiking out above 20 that we're going to go back into a bear market and back into a downtrend. You have seen the behavior of the VIX all year long, and we have spent so much time below 20, and that is just not the behavior in the VIX you're going to see in a bear market. So the trends are still bullish and the VIX is still crushing below 20, so that is definitely telling in itself. And then finally, let's take a look at Apple stock, because Apple is one of those market moving companies. And I said last time I made this update that we were very likely going to see Apple repeat the same exact move that we saw in Microsoft leading up into earnings, because these stocks are going to move together. And that is exactly what we saw in Apple stock. Now, once you get that move is likely over and there's not any more coming to that move. So now we are looking at the possibility that Apple earnings is going to be sell the news, and we're going to need to correct this bull trend and maybe see a little bit of a cool down before we go any higher. So with that being said, you need to watch Apple very closely, because it is a market moving stock that could be due for a correction. And if there was going to be a correction, it's more than likely going to be in the month of May after reaching our upside price targets. So if there's any reason to be bearish, Apple could be a very good reason if we see price action breaking below this support and continuing into a downtrend. That is going to be a very early warning sign as a leading indicator of the market that one of the biggest market moving names that is reaching its price target that just reported earnings could be due for a sell the news event. So there are definitely reasons to be concerned and be cautious and manage your risk accordingly, because if we start to see price action confirming a rollover in the market, we do not want to get caught on the wrong side of the trade. So as I always tell you, let the price action do all of the talking and make sure you are prepared for a scenario where we blast off higher or we start to break down and roll over and lose the bull trend. If you are prepared for either scenario and you let the price action tell you which scenario you should be trading, then you will do very well in this market and you will understand exactly how to manage your risk, whether we go higher or whether we go lower. So going into FOMC tomorrow, as far as I'm concerned, we have a very clear range and you can either trade that range or wait for the bull breakout or the bear breakdown. And either way, you need to be prepared for either scenario. We know the exact levels we need to pay attention to, and we're going to let the price action do all the talking from here. If you want to come trade with other price action traders and get access to all of my intraday updates and analysis, come join us over at the Stocks Channel Trading Discord community. I also have my own trade alert service called Bank Trade Alerts that sends you all of your buy and sell alerts directly via email and text message and only trades the ETFs TQQQ and SQQQ. You can find out how to join Bank or the Stocks Channel Discord by clicking on the links in the description of this video. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.